Today's presentation will explore the impact of rising mortgage defaults on the banking sector in the backdrop of rapid mortgage rates increase and the corresponding responses. Topics include current state of Canadian mortgage market and the causes, impact of mortgage defaults on the banking sector, current response, and potential strategies. Let's explore the current state of Canadian mortgage market, starting with the benchmark rate and mortgage rates. The left chart shows long-term low benchmark rates led to a high inflation of 8%. The consecutive rate hike begins in March 2022, effectively controlled the inflation. Due to the higher borrowing costs, mortgage rates of commercial banks also continue to rise and curb the overheated real estate market. Now let's see how mortgage rates affect the real estate market before the rate hike. First, mortgage rates are linked with house price. Lower mortgage rates encourage home purchases and push up house prices. Conversely, high mortgage rates will reduce house prices. Data in the left chart confirms this. From 2008 to 2022, low mortgage rates increased Canada's average house price by 142%. Also, low mortgage rates greatly affect home buyers' behavior. Due to the low repayments caused by low mortgage rates, home buyers will ignore the increase in mortgage amount. For investors, they have a greater motivation to take on larger mortgages to gain more profits. Therefore, low mortgage rates provide impetus for a substantial increase in mortgage volume. However, how can such a huge mortgage volume be achieved? The chart shows average value of new mortgage rolls since 2012 reached peak in 2022, an increase of 64%. Canadian banks take income as the most important factor to assess the borrowing liability. The mortgage limit is usually 4 to 4.5 times the borrower's household income. Usually, prime mortgages at lower rates offer to borrowers with good credit histories, and subprime mortgages at higher rates to riskier borrowers. Federal government even introduced a stress test to ensure borrowers to repay mortgage smoothly after mortgage rates increase. However, huge profits attracted investors to obtain a high proportion of debts to maximize potential returns. Strict regulations of traditional mortgage market pushed them to unregulated mortgage markets such as private loans. Thus, the high leverage and unregulated mortgage markets have driven a sharp increase in the total mortgages. In the case of a sharp increase in total mortgages, rising mortgage rates become the fuse for default risk. Mortgage rate hikes in the past 2 years have greatly affected borrowers' affordability. As shown in the above chart, the year-on-year growth in average monthly mortgage repayments have shown a rather sharp upward trend since Q1 2022. Borrowers who got large mortgages at higher rates on the unregulated market are in even greater trouble. Leverage expands their potential returns as well as their potential risks, and these high leverage borrowers will prioritize repaying high-interest private loans rather than bank mortgages. Royal Bank predicts that after non-mortgage debt defaults have shown a clear upward trend, the lagged mortgage loans will also rise in the coming year and will continue to rise in the medium and long term. Data from the Canada Mortgage and Housing Corporation in the above chart shows that since Q3 2022, the default rate of large mortgages over $400,000 has already shown a clear upward trend. Overall, after mortgage rate hikes, the large mortgage volume caused by low mortgage rates has increased the risk of mortgage defaults sharply, which will become a serious weakness in the banking sector.
Next, I explore the impact of rising mortgage defaults on the Canadian banking sector, focusing on three main effects. Firstly, increasing credit loss provision have a significant impact on banks' balance sheet. As mortgage arrears accumulate, banks face a higher risk of borrowers' defaults, which lead them to increase their provision for credit losses. This adjustment is crucial as it covers potential losses from overdue mortgages and is recorded as an expense on the income statement. Consequently, a higher PCL negatively affects the bank's profitability. For instance, the Royal Bank of Canada reported a substantial increase in PCL to $2,468 million in 2023, from $484 million in 2022. This rise in PCL has led to a noticeable decrease in net income and a drop in return on equity to 14.2%. Quarterly results indicate a consistent increase in PCL starting from the second quarter of 2022, primarily due to higher provisions for impaired loans. Secondly, to manage increased risk and declining earnings, banks often reduce credit availability. In response to the growing number of mortgage defaults, the Office of Superintendent of Financial Institutions introduced measures in March to tighten lending standards. One key measure is the loan-to-income limit for new uninsured mortgage loans, capping mortgage portfolio at 4.5 times the borrower's income per quarter. Unlike insured mortgages, which are government-backed and pose less risks to banks, uninsured mortgages carry a higher risk of defaults. As banks become more conservative in their lending practices, a credit crunch can occur, represented by a sharp and sudden reduction in loan availability. As a result, as this graph shows, this is evident in the declining outstanding balances for both new and existing residential mortgages from chartered banks. Lastly, significant mortgage losses compel banks to adhere to stricter regulatory requirements. As mortgage defaults increases, banks often lower their liquidity ratio, redirecting some liquid assets into more productive investment with higher returns. This reallocation helps banks manage their resources among rising defaults. Over the past 5 years, particularly following the COVID-19 pandemics, the liquidity asset ratio has been decreasing. Reduced liquidity makes banks more vulnerable to liquidity crisis, potentially leaving them to insufficiently prepared to cover growing losses from defaults. To mitigate these challenges, OSFI raised the domestic stability buffer by 0.5 percentage point to 3.5% last year, a level that remains in effect today. While this increase helps banks build a sufficient capital buffer to handle financial stress, it can also lead to reduced leverage and slower lending growth. A higher equity level results in a slower leverage ratio, indicating that banks are relying less on debt to finance their assets, which can affect their ability to expand lending.
So thank you, Nana. So come to the bank's response on mortgage default. According to the research, there is mainly 4 ways that the corporate have acted on mortgage default. So first, one of the most direct way banks are responding is to cut the cost. Let's take Blackstone Mortgage Trust as an example. BXMT is a mortgage department of Blackstone. They recently cut its dividend by 24% to against the wave of defaults. So this move saved about 100 million annually, which can be reallocated to new loan or other investment. However, it's important to note that such measure can make negative consequences, such as decline in share price. Well, they might need to buy back their share to stabilize their stock price in the future. So as Nana mentioned before, the PCL, also known as the provision for credit loss, they are found that set aside by bank to cover potential loan default. In 2024, Canadians' Big Six bank increased their PCL from 4.1 billion to 4.3 billion in just 1 quarter. So this proactive approach ensured that banks have a financial cushion to absorb potential losses. So next, to reduce the likelihood of default, some corporates are establishing incentive measurement. For instance, in US, the United Wholesale Mortgage has introduced additional compensation for broker handling mortgage through Veterans Affairs or the Federal Housing Administration. So this not only offer lower interest rate for home buyer, but also help convert potential non-performing loan into performing loan and stabilize the bank's loan portfolio. At the same time, it benefits all the 3 parties, the lender, borrower, and advisor. So come to the next, despite the negative reputation of mortgage-backed security since 2008 financial crisis, with the tighter regulation control, there is still 11 trillion security outstanding and 300 billion average daily trading. By looking at the left, we can see that Canadians' mortgage delinquency rate is dropping around until 2017. And on the right, statistics showed by Federal Reserve, it showed that the CMBS and RMBS, C stand for commercial, R stand for residential, are still quite a lot. So the last part is something quite interesting when I doing the research. In additional to those four measurements, the regulator and insurance company are also helping the bank to respond. So this year, Federal Reserve are reevaluate the accuracy of AI-backed automatic valuation model on loans to make sure it is still work when AI plays in part. At the same time, interestingly, there is quite a few insurance company are now buying loans directly from banks, not MBS anymore, not like 2008. It will help the insurance company to save more cost and better rating compared with the traditional MBS, help the bank to diversify the default risks. But this might bring up the tension because is this something new to bring economy damage? We're not sure. Policymaker might need to pay attention on that. I'll hand the mic to Yu to talk more about MBS.
So I'm going to talk about how banks have used new financial tools to handle the challenges of high interest rates and mortgage defaults. Financial innovation means creating new financial products to help banks and markets work better. One such innovation is mortgage-backed securities, which are bundles of home loans that banks sell to investors as bonds, instead of the banks bearing the risk. If a homeowner cannot pay, the risk is transferred to the investors who buy these bonds. This method not only protects banks from the direct impact of mortgage defaults, it also offers diverse investment opportunities through different tranches of risk and return. Banks also use credit default swaps as a form of credit risk insurance to further safeguard their financial stability in volatile markets. For example, in Canada, high interest rates have led to more missed mortgage payments, which can hurt banks. Recent statistics also show a concerning rise in mortgage delinquency due to increased interest rate, which highlights the importance of these financial tools. While mortgage-backed securities and credit default swaps are effective, we still need careful credit assessments to prevent repeating past mistakes, like those from the 2008 financial crisis. As we move forward, these innovations continue to play a crucial role in stabilizing our financial systems during economic uncertainties. In short, the Bank of Canada's benchmark rate has a big impact on our mortgage market. When the bank raises this rate to control inflation, mortgage interest rates go up, making it harder for people to pay their loans. Banks try to manage this risk by checking if borrowers can handle their payments. However, when rates go up unexpectedly, it can lead to more defaults and losses for banks. This has made banks send more money for potential losses and issue fewer new mortgages. To handle these risks, banks use financial tools like mortgage-backed securities and credit default swaps. These tools help banks transfer some of the risks to investors and get insurance against default. By using this innovation, banks can better manage risks and protect their financial stability. And so here's there are two slides is our references. And basically that's all about our presentation, and thank you for your listening.